break from sunny, warm Chicago, and happy Father's Day. I'm John Kosar, Chief Market Strategist and Portfolio Manager at Asbury Research. Thanks for viewing our latest Following the Money podcast. Today's date is Sunday, June 15th, 2025. Before we begin, here's just a little bit of information about us. Asbury Research is a registered investment advisor and has been providing both investment research and asset management to individuals and professional money managers since 2005, which makes this our 21st year in business. We have two levels of research service available. Our Asbury Premium for more serious investors. It includes all the latest updates on all of our data-driven models and some one-on-one personal instruction via Zoom. We also have an entry-level Substack newsletter that's relatively new for $25 a month. There is also a free version of the Substack. So if you like our videos, I strongly suggest that you sign up for the free version of the Substack newsletter. You can do that at asburyresearch.substack.com. We also offer managed accounts for both individual investors and also for other portfolio managers as a third-party manager. This year, through Friday, 6 of our 7 model portfolios are outperforming the S&P 500 with significantly lower drawdowns, lower standard deviation, and lower betas. Contact us via the Contact tab, which is right here, at asburyresearch.com for more information about these model portfolios. In today's podcast, our focus is on the potential dangers in the U.S. stock market following a meteoric 25% rise in the S&P 500 over just the past couple of months, really since the early part of April. Couple that with upcoming but yet to be determined tariffs. How much and who are the tariffs going to be with in terms of the other countries? We also now have a hot war in the Middle East between Israel and Iran. And we've got a U.S. dollar that we're going to look at a little bit later in the podcast that is teetering at 3-year lows. We'll talk about that and what that may mean for later on this summer. So let's begin by looking at our Asbury 6. So we're going to go into the Research Center and we're going to click the Asbury 6. So the Asbury 6 has been risk on since April the 23rd, and since then, the S&P 500 has risen by as much as 13%. It is now equally balanced, as you can see, though, at 3 and 3. So let's talk about, first let's define what the A6 is, for those of you that aren't really familiar with us. It's kind of our signature model. Everybody seems to know us for the Asbury 6. What the A6 is a daily data-driven gauge of the U.S. stock market's real internal health, according to 6 diverse metrics. We selected them via quantitative backtesting. We basically took all of the tactical tools that I've been using throughout my 40-plus year career in the markets, and we started to backtest them in sets, in 3 and sets of 6. Kind of like figuring out a baseball lineup, right? You want somebody that's going to get you on base batting 1, then to move the runner at 2, and make some contact at 3, and so on and so forth. We kind of do that process when we're building models. We take different indicators that do different functions, and when you put them together, theoretically, and at least in our case, you could turn out some pretty significant. So every one of these individual indicators that you see here, they all have Achilles heel. There aren't any indicators that I've ever come across that are right all the time and don't go through certain economic periods or just general periods during normal trading where they stop working for a while. So we have paired these 6 together and backtested them. And what we found is that going back 7 years, the A6 has outperformed the S&P 500, or it's been a relative performer. It's been either been right with the S&P 500 or a little bit better than the S&P 500, with significantly lower standard deviation and lower beta. Beta, if you don't understand beta measures the stock's volatility relative to the overall market, and standard deviation, a lower standard deviation indicates more consistent returns and lower risk than the S&P 500. So year to date, A6 has outperformed the S&P 500 by a little more than 2%. What this 3 and 3 means, we still are holding on to the positive signal that we've had since April 23rd in the A6, but the 3 and 3 now indicates the market's. What this means is that in order for the indicator itself, the model itself, to stay positive, we need to move back to 4 or more green here, and that typically happens over the next few days. This should turn to 4 red. That indicates that, again, for the first time since the latter part of April, the market is internally weak enough to facilitate a sustained move down. We're going to be really watching the A6 close next week, especially with this war going on over the weekend. We don't know how we're going to open up this afternoon in the futures market, which is usually early evening, and it should be an interesting. The next thing we're going to look at is sector rotation via our SEAF model. So SEAF is an acronym. It stands for Sector ETF Asset Flows, and it's a completely data-driven sector rotation model. We created the SEAF here probably 7 years ago, 7-8 years ago, to quantitatively identify long and overweight opportunities in U.S. market sectors by following the money as it moves around the 11 sector spiders. These are the 11 sector spiders here. And if you put them together, you've got the S&P 500. SEAF is always fully invested in the market. And the way we explain it to our customers, especially for money management, is it provides investors with a dynamic alternative to that part of their portfolio that they may always keep in the market. The buy and hold portion of investors' portfolio. Generally speaking, most investors do not like to be in cash, all in cash. And if you're a money manager, you can't. According to your mandate, you generally need to be mostly market. So this, rather than putting it in the S&P 500 or the S&P 1500 or something a little bit more broad, this actually stays with the sectors that are getting the most attention in terms of asset flows. We do this in 3 different time periods. We have trading, tactical, and strategic, and we've come up with a methodology that creates a scoring system. So right here, technology had the second fastest money moving into technology in the trading time period. Tactical, it was number 1, and strategic was number 1. So it gave us a 4. That is the lowest overall score, kind of like in golf. The lowest score wins, and that is telling us that technology is getting the money the fastest. On the other end of the spectrum, financials was the fastest money out in financials in the trading category, in the tactical category. These are all time periods, and it was number 9 in the strategic, which gave us a score of 31. So basically, if you looked at this very quickly, the money is flying out of financials and flying into technology. Since SEAF first went overweight tech, or XLK, on April the 28th, XLK has risen by 15% outright and has coincidentally outperformed the S&P by 6%. So right now, through the end of last week, based on asset flows, not on what we think or what's coming out of the White House or what we think earnings is going to be, this is based on watching the money move around the board. Right now, we continue to look at technology as an opportunity for an overweight or for an outright long position. When the money moves, we move with it. If something happens over the next couple of weeks, we will see what happens on SEAF, and we'll adjust our portfolios accordingly. Next thing I want to look at is our sort report. I've been trying to cover the sort report every time that we're with you every couple of weeks. It's a part of the Substack service, the less expensive Substack service, which is $25 a month. So let's go there and have a look at Sort. First, let me tell you what it is. Let's get over there. So this is the landing page for asburyresearch.substack.com. There's a way to sign up for free here, but the Sort is a part of the package for $25 a month, and that's where we're going next. And Sort, if you can't make this a little bigger. There we go. So the Sort report tells us which parts of the global market have positive trends, are outperforming their benchmarks, and have positive asset flows, which means that there's new money coming in that are pushing the price of the ETF higher. This is just based on data. It's not on our opinion or economic forecasts or anything of the kind. It's kind of a three-legged stool that we think is really important here at Asbury. Trend, relative performance, money flow. So this week, this graphic is showing us that there are a number of these that have green all the way across, which means they're checking the boxes of positive trend, positive relative performance, and growing money flows throughout. For the past month or two, it's been technology, and it's been global equity, who's SPDW for that. This week, we've added emerging markets. We've added crude oil. We've added broadly commodities. There's an ETF we track for that. It's DBC. You can see it right here. Gold. So again, QQQ, which is tech. SPDW, which is global equities, less the US. Emerging markets is EEM. We have crude oil, USO we use for crude oil. C is commodities, GLD for gold. And then these bottom four do not have three across, so we do not see those as opportunities. Since April, QQQ has risen by as much as 33%, while outperforming the S&P 500 by 3%. Right up here at the top. Next, I'm not going to go through all these, but just a few, just to show you how they fared after they showed up on the SORT report as checking those three boxes for us of trend, relative performance, and money flows. SPDW has risen by 27% since April 9th, while outperforming the S&P 7%. And EEM, which is a little bit later, it came onto the SORT report, but since April the 9th, that has outperformed the S&P, or that has risen outright by 26% and outperformed the S&P by 5%. The next thing we're going to do is we're going to look at a few charts from one of our premium reports. It's keys to this week. It comes out at the end of every week. There's a few charts here that I wanted you to see, especially with what's going on now in the Middle East. There's just a lot of turbulence out there that could really shake these markets up. So this is what we're watching. This is what we're paying attention to. So the first thing we're going to look at is support in the S&P 500 and also the resistance. So right now, this is through Friday. So we started to break through this minor resistance level at 59.86, and we roll back down through it on the downside at the end of the day, Friday. Big levels to watch. Up top is 61.47. That's the all-time high that we made in February. And then this is about 3% higher from Friday. About 3% lower than where we finished on Friday is 58.07, 57.87. That's the 200-day moving average here in orange. It's a minor trend proxy. And also the high that we made on March the 25th. Put those both together. And again, that's about 3% below the market. As long as that holds, the major trend as we see it is still bullish. It's still up. If we broke down through this 5,800 area, that would be a problem. Again, the A6 is going to turn to red. The Asbury 6 will turn to red long before we get anywhere near this 5,800 area. So a few things to watch. A6 starts to turn red and stays red. we're probably going to at least pull back to see a test of 5,800, which right now is about 200 S&P below the market. Next thing on the positive side, this is Microsoft. This goes back to 2024. It's a daily chart. It shows you that on June the 6th, Microsoft set a new all-time high. Why do we care? Microsoft is one of the Magnificent Seven, and it's a giant stock in terms of market cap. It has maintained a 30-year positive linear correlation. According to, we use a Pearson coefficient in order to determine linear correlation. The correlation between Microsoft and the S&P and in Microsoft versus both of the NASDAQs has been tight and stable for the past 30 years throughout that period. So as goes Microsoft, generally speaking, so goes the rest of the market. So keep an eye on 468.35. That was the old high that we made in July of 2024. It's support. As long as we hold it, even if we have a little pullback in the market, this is indication, at least it will be us here, that the market still has legs on the upside. The next positive thing that we're going to look at is this is the investors' intelligence data. Asbury Research is actually one of the inputs for the II data. They have their sentiment data broken up into different segments. This is the bulls minus bears segment. And what this shows is that on April the 4th, it reached the least bullish extreme that coincided with just a matter of days to the bottom that we made in the S&P 7th. If we go back through time, we can see it was down at the same extreme in October of 22. That was a big bottom for the market. Also, this is March 27th of 2020. That's the low that we made for the COVID collapse. January 29th was another important one. March of 2016, Sep 2011, all the way back. Why am I showing you this? Because it suggests to me, to us, these extremes in sentiment don't happen every other day. They generally, or at least historically, they usually identify multi-quarter lows in the market. So this again suggests even if we have a pullback, even if Asbury 6 goes to 4 or more red, some of these longer term charts suggest that we made a tangible, sustainable bottom. It doesn't mean that we can't go back and retest it, but that there is a more sustainable bottom than just a couple of months at these April lows. Finally, this chart is a little bit concerning to me because it has to do with the U.S. dollar. The U.S. dollar is sitting on 3-year lows, 2.5 to 3-year lows here. This is through Friday. So this support in UP, which is for the U.S. dollar, shows the support at 27.43, 26.91. Why do we care? If the U.S. dollar goes through a sustained period of weakening against the other major currencies, and if we break down through these lows, there's probably going to be some follow through. There's going to be a lot of people throwing in the towel on the dollar. It means that foreign buyers of American-made goods are going to have stronger purchasing power since their currencies will have gained value versus the dollar. The other thing that it does, it boosts, it could increase our inflation. So I'm looking at this and I'm looking at tariffs. And after what goes on in the tariff situation here, as it continues, the days and the weeks tick by, we're going to get a lot more clarity there. And if the dollar falls through the support, it's going to suggest to me that the wisdom of all of the collective money that goes into the dollar, that goes into currency bets, is betting that these tariffs are going to be big enough to cause inflation in the U.S. It affects our interest rates. This can just really create a lot of problems. So is there any direct thing to do here than selling the dollar? No, but it's kind of foreboding as to what this could mean down the road, especially as it applies to. So A couple of quick announcements. I'll let you go. Enjoy your Father's Day. I will too. On Wednesday, June 18th, I'm going to be a guest on the Schwab Network's Morning Trade live show, which airs at about 9:50 Chicago time on Monday. Also, on Monday, June the 23rd, that following Monday, I'll be a guest on Chuck Jaffe's syndicated show. It's actually a radio show called Money Life. Airs all over the country. Go to moneylife.com. I believe if you just Google Money Life, you can see where it's playing around the country and when that interview will be available at our radio station. So there you go. A lot to cover today. A lot of going on geopolitically. A lot of stuff can happen between now and when I see you again in 2 weeks, which is tentatively scheduled for Sunday, June the 29th. For questions or more info on any of our research models or model portfolios we talked about today, the best way to contact us is go to the contact tab at asburyresearch.com. Please don't forget to like and subscribe. Thank you. Have a wonderful Father's Day, and I'll see you again right here.